Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, Amazon announcing a $38 billion computing deal with OpenAI. We'll discuss. Plus, we'll hone in on the Fed's rate path and sit down with Chicago Fed President Austin Goolsbee. And we'll also be zeroing in on the state of the economy as a new report highlights slowing income growth for young workers. Taking a look at the major averages, we are seeing a mixed picture here. Right now, the Dow is off about 181 points, about 0.4%. The S&P 500, little changed here, and the Nasdaq is up 0.6%. Now, in terms of what else I'm watching here today in terms of asset classes, we are seeing an increase in yields, which is notable. We had seen, of course, sub 4% yields. That had been something that we've been watching closely, and now we're seeing them come back up again. That has been affecting different areas of the market, including some of the interest rate sensitive groups. So real estate, for example, today is the worst performing group. That's something that bears watching. The best performer, XOY, which is consumer discretionary, which includes Amazon, which we just talked about, signing this $38 billion deal with OpenAI, giving OpenAI access to computing power powered by, of course, NVIDIA GPUs. And NVIDIA shares are up by about 2.4% today. Microsoft also signing a data center deal with IREN, which is a so-called neo-cloud provider of data center capacity. So the AI trade continuing apace. And in the meantime, markets are now pricing in about a 69% chance of a rate cut in December. That's despite a growing number of Fed officials casting doubt about another cut this year. Going to send it over now to our Federal Reserve correspondent, Jennifer Schonberger, who's speaking with a member of the Federal Reserve. Jen?
Thank you, Julie. Joining me now at a first on Yahoo Finance is Chicago Fed President Austin Goolsbee. Austin, thank you so much for joining me. It is great to see you again and great to have you back on the program.
Thank you for having me back. Yeah, thank
you. You had said before the policy meeting that you were somewhat uneasy about front-loading rate cuts based solely on slowing payroll growth, and that at the same time, inflation had been moving in the wrong direction, and just counting on inflation to be transitory made you uneasy. So why did you vote in favor of cutting rates last week? Was there anything that changed that caused you to want to take out more insurance?
Well, before the last meeting, not this November meeting, but in September, we issue the statement of economic projections, our dot plot projections of where the economy is going to be and where rates are going to be. And at that time, I thought there would be 2 rate cuts for the year. I'm balancing off 2 things. One, as you know, I believe that the place rates will ultimately settle is a fair bit below where we are today. And as long as we can get the dust out of the air, I still think that golden path is possible. And I'm trying to weigh that off with these concerns about front loading, especially when we have the data shut down. We're getting some information about the job market, and we have very little private sector information about inflation. So I think we want to be wary, but I'm still just trying to balance those off. Not much change since the September SEPs, and so I had no problem with that.
So, Austin, you're saying you're trying to sort of look through all this dust, waiting for it to settle. You had penciled in 2 rate cuts for this year, and Chair Powell had said after the policy meeting last week during his press conference that there's a feeling that you've cut twice and you're now 150 basis points closer to neutral than you were a year ago, and that there is a growing chorus on the committee that perhaps maybe you should wait. Are you one of the chorus?
I'm not supposed to say anything about what other folks say. In my mind, as you know, I am uneasy with front-loading rate cuts. I do believe rates will come down, but in a way, rates should come down with inflation. We've got to, if we're just going to count on the inflation that we've seen here, where the last 3 months core inflation is running 3.6% at an annualized rate, and core services, I think, are running close to 4% as annualized rate for the last 3 months. That's worrying because that's going the wrong way. If we're just counting on that to go away because it's transitory, that makes me uneasy. So I'm not decided for what I think about the next meeting, and we are still going to get at least some private sector observations and the Chicago Fed's labor market indicators telling us some about the job market. We're probably not going to get much on the inflation side, so I am a little wary, and my threshold for cutting is a little bit higher than it was in the last two meetings.
So to your point, Fed Chair Powell used the analogy of when it's foggy, you want to slow down, become a little bit more cautious. Is that a fair characterization for you? And how are you viewing the balance of risks, fully recognizing that we haven't had official data on the labor market side because of the government shutdown? It sounds like you may be more worried about inflation than employment now when you look at the balance of risks.
I've been a little more worried about inflation than the job market if you think of it as a balance of risk, for the reason that other than payroll job growth, if you look at things like the unemployment rate or other rates that are less affected by population changes or immigration policy, those things have been pretty stable for some time. If you look over the last 12 months, the unemployment rate has not been going up. We haven't seen a big uptick in layoffs, which if this were the beginning of recession or deterioration of the labor market that was rapid, you would expect to see higher layoffs or firing, and we haven't seen that. There's still concerns on that side. And as you say, we're going to get some private sector data, so we can at least keep observing that. But I just want to emphasize, be very careful at moments of transition where you're trying to figure out whether the economy is turning, relying too heavily on 12-month backward-looking numbers like the 12-month trailing inflation. Each month we get a number, and 11 of the months we already knew. The new information is only for that new month. So the fact that the last 3 months inflation is not going down but is instead going up, including in some categories that are not driven by tariffs like services, those are areas of concern. And so that's a little bit, the last time you looked out the window, there was a mountain lion sitting in your front yard. So before you let Fluffy out to go run around, let's at least get one more look.
All right. Well, aside from Fluffy, I do want to come back to the job market because, yes, payroll growth did slow over the summer months. And since then, you sort of have been in the dark as far as official data. But last week, we saw some major layoff announcements from the likes of Amazon to UPS. If you did look at private sector data, ADP's measure turned negative for the month of September. We're going to get another measure this coming Wednesday. And the Beige Book revealed that employers are looking at cutting headcount either through attrition or layoffs due to policy uncertainty, weaker demand, and AI. Does that not worry you? Do you think that perhaps payroll growth has decelerated further since you have gotten official data?
It might have, and that's why, as I say, I'm not decided going into the next meeting. I want to see how things are playing out. I do think the public announcements of layoffs, you would expect, if that is an immediate business cycle driven matter, that you would start to see an uptick in the official unemployment insurance statistics or the layoff statistics, or you would get WARN Act type data of that form that would give you a little bit of a heads up of what was coming in the job market. I do think the hiring rate is low. That's among the weakest things in the economy at the moment, and that's made it particularly tough for new graduates and young people. But a low hiring, low firing economy is unusual. That's the kind of economy that you expect when there's a lot of uncertainty. Normally, in the business cycle, you would have low hiring, high firing, or low firing, high hiring. When you get uncertainty, both of those go up as people kind of pull back and say they want to wait to see how things are going before they make decisions. This whole second part of what's going on in the job market, if it is being driven by AI, if it is concentrated in the tech sector, That doesn't feel as much like the business cycle to me and economic stabilization. That feels like more of a structural shift in what sectors are going to be employing people. So we have to think through, what does that imply for monetary policy? That's a little different than if you were afraid that we were going into recession.
Yeah, so to your point, what is all of this telling you about the outlook for the economy in a cyclical sense, right? Not a structural sense, because that is what you have control over at the Federal Reserve. Perhaps are we at a turning point in the economy, given what we're seeing in private sector job market data that GDP data is not yet reflecting?
Yeah, look, I always say one of the hardest things the central bank ever has to do is get the timing right on moments of transition. And that's especially difficult if you have squished bugs covering the windshield and you can't see whether you're still on the road. And when they shut down the data, the official data, that's the circumstance we're in. So I don't know that it's decided. I'm not decided going into the December meeting. I am nervous about the inflation side of the ledger, where you've seen inflation above the target for 4.5 years, and it's trending the wrong way. I believe on the other side, rates can come down a fair amount. It would probably be most judicious to have the rates come down with inflation. So let's get some observations that document that inflation is coming down and that the uptick we've seen is transitory. But we've got to weigh that off. If the job market starts to deteriorate in a more significant way, then that would change the balance of risk.
And Treasury Secretary Scott Bessent said yesterday that he believes that parts of our economy, particularly housing, may be in a recession already. Sounds like you may disagree with that. What are your thoughts on that?
Well, I think he's right that the housing construction sector's been weak. It has been weak now for some time. The three most interest rate sensitive parts of the economy usually that give you a sense of the business cycle are housing, consumer durables, and business investment. I think he's right to highlight housing's been weak. Consumer durables have been pretty resilient. And you saw, as you said, the GDP numbers coming in and consumer spending coming in pretty solid. And business investment has been kind of off the chain. Now, much of that driven by the AI boom, so that might not be cyclical, but the interest rate sensitive parts of the economy don't feel like they overwhelmingly point to that we're in a slowdown. I think that the economy has been pretty strong. The economy is pretty solid and has been. There's weakness in sectors, and anybody who's dependent on intermediate goods that the tariffs are applying to has been suffering. But other parts of the economy continue to grow, and overall consumer spending remains the main driver of solidity. Is that of the solidness of the economy has been largely based on consumer confidence.
Well, Austin, unfortunately, we're out of time. We'll have to leave the conversation there. Always so many more questions for you. So appreciate your time and insight this morning. Hope you'll come back and see us soon.
Yeah, anytime, Jennifer. Thank you for having me.
That's Austin Goolsbee, head of the Chicago Federal Reserve. Julie, I'll send it back to you in New York.
Jennifer, thanks so much. Thanks to Austin. Never short of metaphors. Gotta love all of those. Coming up, we're gonna get some reaction to what Austin was just talking about and preview what the Fed may be doing with Rick Rieder of BlackRock. We'll talk more about the economy, the Fed, and where to find opportunity in these markets. We'll be right back.
I'm not decided for what I think about the next meeting, and we are still going to get at least some private sector observations and the Chicago Fed's labor market indicators telling us some about the job market. We're probably not going to get much on the inflation side, so I am a little wary, and my threshold for cutting is a little bit higher than it was in the last two meetings.
That was President of the Chicago Federal Reserve Bank, Austin Goolsbee, just speaking with our Jennifer Schonberger on whether he'll back a rate cut next month. Of course, this adding into the debate, both inside and outside of the Federal Reserve, over whether there will be a cut in December. And here to help us and weigh in on all of this is Rick Rieder, Chief Investment Officer of Global Fixed Income at BlackRock, which manages $3.2 trillion in fixed income assets. Good to see you, Rick.
Good to be here.
Thanks for coming in.
Yeah, pleasure.
So you heard what Austin was just saying.
Yep.
And, you know, it's almost remarkable to me the extent to which there is still a pricing in that there will be a cut in December. Do you think it'll happen?
Yeah, I mean, I think it will happen. But listen, one thing I've learned about markets is you have to interpret what they are saying. There is a part of this committee that definitely would like to wait and evaluate the data. I think they can go. I think they should go. I think they can go quicker. But I respect the fact that inflation is running a little higher. I would argue, you know, you're still, if you take 6 months core PCE, you're running at about 2.5%. Other metrics, you're running closer to 3%. My only view being that's not an infectious inflationary expectation dynamic that allows the Fed to move. In fact, in the market today, you can buy 5-year inflation break-evens at 2.5%. It's not like the market thinks inflation is a problem, such that I think the window is there. I have a stronger view that I think labor is a tricky thing from here, and I think there is significant displacement on labor that we're going to see over the next couple of years. Last week being an embodiment of that when we heard from Amazon, UPS. Technology is changing the world. I mean, I was on a call with the CEO today, and we're talking about data center investment. When you go into data centers, you don't see a lot of people. You see a huge amount of CapEx. So it buoys the economy. You just don't see a lot of people in those facilities.
No, although you have to build them, right? You have to build them, you have to outfit them. That all requires people. But then when they're done, to your point, there's nobody there.
That's right. And by the way, it's not just AI that's creating this productivity. You talk about things around inventory management, logistics, client procurement, predictive maintenance. I mean, productivity is exploding everywhere. It means you see it in all the corporate earnings. Companies are doing well, the revenues are decent, cost of goods sold is coming down, their SG&A is coming down. You can operate with a lower cost threshold. That's why you're seeing M&A that's so high. I got to get bigger, I got to vertically integrate, I got to use data, I've got to use AI, and I don't need as much fixed infrastructure, including people.
So this so-called low hiring, low firing environment that we keep talking about, has that already changed? Are we just not seeing it in the data yet, but we have the anecdotal evidence?
So listen, there's no doubt that is the best characterization of where we are from a labor perspective today. My sense is companies are waiting, and you're seeing, I think today, I talked to CEOs who tell you, I'm comfortable with my labor force today, you saw Walmart freeze hiring. Let's stay where we are, let's see if we can grow our business, and then you'll see some companies that proactively will reduce labor. I think, so if you take the last 4 months of data that we have gotten, and I don't think it's going to change much, the data we think is going to come is going to show the same thing. The last 4 months, if you strip out healthcare is not cyclical, it's not interest rate sensitive, we have negative job growth. I think that is something that is going to be persistent. Hopefully, the economy continues to be resilient, which I think it will. Actually, the economy's in good shape. I think the economy's in good shape, companies are in great shape. I think labor, not so much.
Okay, so here's the question then. So say the Fed cuts because they're concerned about the labor market. What does that do for the labor market? How does it help the labor market?
So there's a few things. By the way, you brought up the most salient issue. So by the way, what is the interest rate effect today? In inflation, you think about what's sticky inflation? Healthcare, insurance, education, pretty hard to get interest rates to help healthcare, insurance, education. Shelter is actually one that actually you can help. You bring the rate down, you help inflation.
But shelter's not the one that's the problem as much right now. As Austin just pointed out, it's the services inflation right now that's accelerating a little bit.
Those are the ones that are, but those are really, right. But shelter is coming down. By the way, something you're starting to see is the mortgage rate has come down to around 6%. All of a sudden, existing home sales are higher. You build more houses. You look at the earnings reports from the D.R. Hortons, the KB Homes, the Lennars. We're not building enough houses. Why? Because the home builders have to subsidize the mortgage rate. If you get that rate down, we'll get more housing. You'll bring down shelter. Listen, I think shelter is still the trickiest one. And what helps when you build more houses? Labor mobility. You lose your job in one state, I can move to another state. You create more velocity, and you can't AI building a house. Your point about data center.
Right.
If we can put a lot of people to work, there are so many reasons for doing it. Point being, listen, the interest rate tool today Doesn't really affect CapEx because who's spending on CapEx? The big hyperscalers, et cetera. They fund through free cash flow.
And they also have a fiscal tailwind. I mean, not just AI, but in general,
Totally.
there's a fiscal tailwind for CapEx.
Totally. So that, I mean, it's not really, interest rate doesn't really affect CapEx like it used to in the 70s and 80s. Now, what is the interest rate affecting? Small business, 44% of the hiring in the United States. By the way, slowing, having a tough time. We need to help small business. Low income that borrows on their credit card, borrows student loan, borrows through other mechanisms. That is hurting. Housing is hurting. And by the way, the US government, 90% of what we finance in treasuries is 2 years and in. You keep the interest rate 100 basis points above where it should be, and that costs the country $100 billion per annum. So point being, the interest rate tool is not like it was in years ago when it was the calibrator, it was the modulator of growth in the economy. It affects the people that are getting hurt today, and it doesn't really do much for CapEx.
And so you think they will cut in December as a
Yeah.
result of all of this reasoning?
I do.
We talked about a year ago at our big Invest conference, and then I quoted you for months afterwards because at that. But what's so fascinating to me is how much the world has changed since then. Because at that time we were talking a lot about the deficit and how concerned some corners of the market were, but. If you remember, you said it's not the shark closest to the boat. It is not the most immediate threat. And in fact, that threat has seemed to recede even more between now and then. Do you think that is, what do you think is the shark closest to the boat? And do you think it's okay that we're not as worried about the deficits right now?
So, I think I said it then, and I'll say it today. I think the amount of debt we have in the country is still a tail risk, but I think it is only a tail risk. We have to keep refinancing. By the way, the fact that 90% of our debt, 89% exactly, is 2 years in, we got to keep rolling immense amounts of debt. That is still the tail risk today. I haven't gone through too many crises in my life, from the housing crisis to emerging market crises, European crisis, financial crisis. It all centers around where the vulnerabilities are, and that's the debt. Today it's at the US government. Listen, I think there are a lot of things happening that allow us, as long as the economy grows, and this is part of my thesis around, we got to run the economy with 5% nominal GDP. I think we'll hit it this year. I think there's a good chance we'll hit it next year. If you keep nominal GDP over the cost of the debt, meaning we get the cost of the debt down a bit, we keep nominal GDP, we'll actually de-lever the economy. So it is still the risk that's out there. Assuming the economy grows and we get the cost of the debt down, we'll be okay. What
is the biggest risk then?
So away from that, I'd say complacency. And when I see in markets, you start to see some things, there's a lot of money in the system. Part of why the equity market, I think, will keep going up. The technicals are extraordinary. People are willing to, to do things to generate return. That to me is out there. And then I don't see a lot. I feel good about the US economy. The only problem with the economy is it's bifurcated. It's the most bifurcated economy I've ever seen. You got working a couple of cylinders on CapEx, a couple of cylinders, high income spending, low income not. So anyway, I think the economy's okay. Geopolitics hopefully is stable. US-China relationship hopefully is stable. To me, it's just complacency and people putting money to work.
Well, and you said maybe going out the risk spectrum a little bit. You didn't say the word bubble, but I'll say the word bubble because it's been uttered by almost everybody lately. Is that... are we looking at that level of speculative behavior, do you think?
When I say no, the big companies today, the ROE these companies are throwing off, I actually went through the earnings that came out last week, and I was looking at the free cash flow that these companies are throwing off. It's like nothing I've ever seen. If you take free cash flow, just the companies, it was Google, Meta, Microsoft, and you look at the amount of, not just revenues, not just cash flow, free cash flow after you've spent on CapEx, they're creating major companies every quarter. And then the multiple, you look at they're trading at 20, 25, 26 times earnings. Now, I see a lot of deals, particularly in the private markets, that are no cash flow, no revenue for the next 2 or 3 years. And by the way, some are good business models. My guess is most of them will fall away, similar to what you saw in the actual bubble back in 2000, when you didn't have any cash flow, you certainly didn't have any revenues. So I do see some of that in the private markets, but generally in the public markets, I don't think it's overdone.
Are the private credit markets? Let's leave aside the sort of tricolor First Brands situations that we saw. Elsewhere, do you think there are problems in private credit?
From a systemic point of view, no. We do a load of financing in real estate, commercial, resi, bilateral credit, bilateral finance. Generally not. I will say things that get auctioned off, like whenever there's a big financing that gets auctioned off, or somebody wants to put their name on something that gets auctioned, like I look at the levels, sometimes it's through the public markets and think, why would you ever do that? There is some stuff, and around the edges in like financing software, what's going to happen with software and AI? There's some stuff around the edges that I think are tricky, but not a systemic, like we saw in prior decades.
All right, Rick, I got to end with this. You are reportedly on the short list to be the next Federal Reserve Chair. I know you can't say very much about it, so I would ask it this way. Is that a job that somebody can say no to if they are offered it?
I'd say being on a list is an unbelievable honor for me, and everybody will evaluate it based on their own particular thought process. Listen, it's a huge honor, and I'm going to go through my process, and I will say today, the investing side of what we're doing is, you were kind enough. We did this ETF called BINC. Mm-hmm. I mean, the amount's up to $14 billion, and it's pretty incredible. There's some fun things to do in the investment arena. So, anyway, I know it's not a great answer, but that's where I'm going to focus.
You're enjoying what you're doing right now, is what you're saying.
I am.
Okay. Good to know, Rick. We'll keep talking, I'm sure.
Thanks, Julie.
Thanks for coming in. Really appreciate it. We got much more markets action coming up. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke Tamama, live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. We're watching shares of Cisco, Netflix, and Roku. First up, Cisco. Shares of the tech company got an upgrade from UBS from neutral to buy. In a note to clients, the analyst cited a multi-year growth cycle boosted by AI infrastructure demand, a large-scale campus refresh cycle, and momentum in security. The analyst went on to say the company secured more than $2 billion in AI orders in fiscal 2025, nearly all from hyperscalers. Year to date, the stock is up more than 20%. Next up, we're taking a look at shares of Netflix because KGI Securities upgraded the stock to outperform from neutral, and an analyst at President Capital Management upgraded its rating to buy from neutral. This comes after the company posted third quarter earnings that missed Wall Street's expectations on both revenue and profit, but it did announce a 10-for-1 stock split that will take effect November 17th. Currently, there are 45 buy ratings, 14 holds, and 2 sells on the street. And last up, we're taking a look at Roku because Piper Sandler upgraded the stock to overweight from neutral. It also raised its price target by more than 50% from $88 per share to $135. The analyst cited strong underlying fundamentals in Roku's platform across advertising and streaming distribution, with more confidence in the company's 2026 revenue outlook, suggesting growth could hit the high teens by the end of next year. Keep it right here on Yahoo Finance. We'll be tracking all the market moves and top calls throughout the session.
Now time for some of today's trending tickers we are watching on semiconductor, core mining, and power management company Eaton. First up on semiconductor, topping third quarter expectations, boosted by demand for its chips in data centers. You guessed it. The chipmaker reporting about $1.5 billion in revenue, and the CEO saying, quote, "We're seeing continued signs of stabilization across our core markets, as well as positive growth in AI, but the shares are down about 0.5%. Next up, Core Mining agreeing to acquire New Gold for about $7 billion in an all-stock deal. Core operates several mines in the U.S. and Mexico, while New Gold has 2 gold-producing sites in Canada. The deal, of course, follows this year's rally for the metal, with prices climbing above $4,000 an ounce. And finally, Eaton, the power management company, will acquire Boyd Corporation's thermal business from Goldman Sachs for $9.5 billion. It's the 4th deal for Eaton this year as it seeks to bolster its data center segment to cater to AI demand. That deal expected to close in the second quarter of 2026. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, we're counting down to a big day here at Yahoo Finance. It's Invest on November 13th, starting at 8 a.m. Eastern. We've got a full day of live coverage of the key themes driving the market, AI, crypto, and much more, with the top guests you'll want to hear from. We've got the biggest names, including Strategy Executive Chair Michael Saylor and Robin CEO Vlad Tenev. Among others, personal finance legend Susie Orman and the Shark Group CEO Damon John also will be joining us with tips to help you build your wealth. Don't miss it. Yahoo Finance Invest on November 13th.
Dave, always great to get some time with you here. Julie mentioned the stock reaction. I think the sell-off was really focused on some of the things you said regarding 2026, how much you might spend to build out your infrastructure. What exactly are you spending on next year?
Hey, I want to highlight, thanks for having me on. We just came off an amazing quarter, and 70% was the magic number in our quarter. We had 70% bookings growth year on year, and 70% daily active user growth year on year, generating over $440 million of free cash flow. We shared with all this growth, we've also hit some peak records, over 45 million concurrent. And what we shared for next year is not necessarily we're going to spend a pile on infrastructure, but we've been seeing incredible improvements in our cost to serve. We just gave a hint that we're going to be investing to stay with our growth.
Have you just outgrown the capacity that you have?
We haven't actually. We've done an amazing thing at Roblox, and I think it showed a lot of foresight, which is very early on. We started building our own data centers, buying our own hardware. And what we've seen over time is amazing efficiency, cost to serve, and just the ability to support what is Roblox. We're now starting to buy more GPUs in addition to our CPUs and our edge data centers. But something really special happened in August. In August, we hit peak records for any game in history. Grow a Garden went over 20 million concurrent players. The way we did this is really savvy and really a future for Roblox, in that for a few hours on that Saturday, we were bursting into a cloud provider while running the vast majority of everything on a Roblox infrastructure. And this is really an optimal way to run, which is bursting for a few hours every week on top of our own hardware.
Dave, this has really been a unique week for tech earnings. I mean, Microsoft, Meta, these big giant tech companies spending billions of dollars to build out AI infrastructure in this country, data centers. As you look to spend a good sum of money to support your business next year in AI, what does that look like for Roblox? Do you build data centers? Can you get the GPUs you need?
We already have GPUs. We're getting the GPUs we need. I do want to highlight at Roblox, we run over 400 AI systems. This includes generative AI. This includes our search and discovery systems. This includes all of our text and voice filtering. It includes our language translation systems. And we're doubling down on building that. We're going to be releasing 4D generative creation in Roblox games in the next quarter, which is going to allow people to, for example, if you and I are playing a game, literally talk about the vehicle we might want to build in the game. So we will be spending some, but once again, we've established a great track record of generating cash. Once again, 440 million in Q3, and we don't intend to change that.
That sounds like it's really going to change the gameplay experience, Dave. How do you see, and you and I have talked about this in the past, but we haven't talked about it in a little bit. How do you see AI changing the development of games?
Well, we see both the changing of the development of games, maybe even bigger than that is what is the definition of a game. And traditionally, as we build out the technology on Roblox, and that technology allows any creator to create a game, have it run on any device around the world, have it launch very quickly, have it auto scale all the way from a low-end Android or phone all the way up through a PC, and scale like we've seen, auto scale up to 25 million. We've already seen the types of games and what are games changing as Roblox has developed. Last summer, Dress to Impress was a big hit. It was a whole new genre, literally a fashion competition with a competitive runway show every 5 or 10 minutes. And then just this summer in August, I mentioned Grow a Garden, which is very unique in that on Roblox, it's both while you're on the game, but your garden keeps growing when you're not there as well. And I'm really proud to think that on Roblox, literally the largest concurrent game in the history of the world is about gardening, which my family's a big fan of. So I think AI is going to support new types of games that involve creation for all of us, games that are right out of sci-fi, like we're in the holodeck together, and we're just getting started.
You put a lot of key numbers on your earnings release, Dave, metrics, DAUs, but what really stood out to me this quarter was hours engaged. It went through the roof. For the layperson that is following this Roblox story, how do you explain all the hours on your platform? And we only have 2 eyes, and sometimes those 2 eyes are watching Netflix or watching other content.
Well, I want to highlight the primary thing we focus on at Roblox is connecting people with optimism and civility. So hours is a byproduct metric. It is not our primary metric. Our primary metric is really around safety, civility, connection, DAU growth, and people having a great experience. That said, there's a lot of people spending a lot of time hanging out with their friends, if they're sick in bed, connecting, even though they can't be at school, possibly learning computer science. And as you hinted, those hours are getting very, very big. One interesting thing behind those hours of engagement, they also supply really exciting data that allows us to make Roblox better. That equates for everyone out there every day about 40,000 years of human interaction is occurring on our platform.
As the labor market softens, a slowdown in income growth among young workers has emerged. Joining me at the desk, George Eckerd, JPMorgan Chase Institute Wealth and Markets Research Director. His team produced this report. And this is something anecdotally we've talked a lot about, George, but you guys have the data here, and it's not terribly encouraging, especially for young people.
Oh, that's true. So, at the JPMorgan Chase Institute, we're looking at, financial data affecting households really directly, and we've done recent research on the labor market, and we looked at, real income gains are actually looking not so hot. Nominally, actually okay, kind of similar rates as we saw prior to the pandemic, so kind of nice tight labor market, but with higher inflation, it's really knocked down purchasing power gains. And as you noted, people around 25 to 29, younger people are affected most by the slowdown in hiring because they do more job switching, and that's how they kind of like climb the career ladder. So when that's kind of ground to a halt, that affects young people most directly.
And so what, their real wage gains are something like 2%? Am I remembering the number correctly? Like how does that compare to what other cohorts are seeing?
Well, it's kind of interesting that young people are actually still growing faster than older people. It's just that kind of the steepness of their life cycle path of income is it's a little shallower. And that really can impact, if you don't make up for that, that can impact your lifetime earnings. So even just a percentage point or two while you're young can really matter.
And does that tend to be the trajectory that you have that pretty quick acceleration when you're younger, and then the growth slows as you get older? So historically, if people aren't doing it when they're younger, are they able to make it up?
Yeah, that's absolutely true, that this is an issue. And I would say that people are trying to find where they fit into the labor market, and that often that's not going to be the first job out of, college or something like that. You have to kind of feel out what it's like to be on the, in the workforce, and job switching is kind of how you find the best fit, how you find a more productive match, and that ultimately supports your income gains. So it's a big deal.
So when we talk about the low hiring, low firing environment, and there's been some concern on a macro level that it's happening, but it's not alarm. But for this is really where it has a big impact, I would imagine, because the lack of job switching you're talking about is because of that sort of low hiring, low firing environment, right? Lack of mobility.
Yeah, I mean, I think it's what we're seeing is downstream of that overall labor market dynamic, and that's what the Fed is thinking about when it's taking these cautionary rate cuts. It's it's in a very challenging place because its dual mandate is kind of in tension. So the labor market and inflation are kind of in tension with each other. But it's looking at this, and the FOMC is trying to do something, but they're kind of constrained in how much they can do to solve the cyclical side of this kind of relative freeze up in the labor market. And we don't want to go too crazy. It's not like these indicators of like quits rate or gross hires, they're low, but they're we've seen them before.
Gotcha. Okay. So it's concerning, but we're not like ringing huge alarm bells at this point. I mean, maybe some of the places where we are seeing it, for example, we were watching Chipotle and Shake Shack earnings last week, and both of them sort of highlighted that young people in particular are not spending as much at their restaurants. So as you guys think about it, what are those kind of knock-on effects? Because if my salary is not rising as much, I don't have as much to spend if I'm in that age range.
Yeah, so kind of to put yourself in the shoe of someone younger relative to someone, say, like mid-career or later, they're more likely to be renters. So when inflation, especially like home price inflation, went up, this had a distributional impact. So it kind of maybe was neutral or maybe even helped some older people that own homes, but young people were less well off. Their rent went up, so they had they were disadvantaged by that. And while we have seen that young people are engaging with the stock market in much greater extent than they used to historically, still they're making new investments at already high prices. They're not riding decades and decades of past gains. So I think that's essentially what you're seeing is downstream at these retailers targeting young people. They're disadvantaged by these asset price and inflation trends.
So when you look forward, and the data that you and your team are looking at, do you expect any kind of change? Do you expect this to worsen? What do you think is going to happen next?
Well, I'd kind of go back to when I referenced the Fed earlier. They're trying to manage this process, and so far, we had high inflation and rate hikes up to 5.5%, and I think there was a lot of uncertainty about whether we're going to have a recession. We're kind of still managing this very extended soft landing, but inflation hasn't come down. So, I think that what's going on here is that we just kind of don't know whether we're actually going to fully land and get inflation back to 2%. But certainly, that's certainly what policymakers are trying to do. But with inflation high, there's just limited room to do that kind of thing.
Right, and limited spending power on the part of some of these folks that you studied.
Right.
George, thanks so much for being here. Appreciate it.
Thanks for having me.
Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. "90 minutes into the start of U.S. trading. I'm Julie Hyman. Let's get a check of the markets. We've been seeing a mixed picture throughout the session here today, and that continues. The Dow right now off by about 213 points. We do have a small gain for the S&P 500, less than 0.1%, and the NASDAQ up about 0.4%. As we talked about earlier, some of the tech heavyweights are rising today, but even amongst them, it's a mixed picture. And then we've got some of the interest rate sensitive groups that are under pressure today with the 10-year yield on the rise. Well, Wall Street was wowed last month by the spending bonanza announced by big tech to invest in the future of AI, and a chunk of that is being financed with private credit. Most notably, Blue Owl's $27 billion joint venture with Meta. It's the largest private credit transaction ever to build the Hyperion data center in Louisiana. But given the recent instability and some questions over the private credit market, could that cause concern among investors? Let's talk about all of this with Mark Lipschultz, Blue Owl Capital co-CEO. Mark, thanks for being here.
Great to be here.
I want to start real high level here because obviously our viewers and Yahoo Finance users have been following the AI data center build out very, very closely. But I'm curious if you could sort of, again, at a high level, talk about the role of Blue Owl specifically in private credit more broadly in that whole universe, because I don't think that many people are aware of it.
Yeah, very happy to. Look, this has been this opportunity, this incredible era ahead in AI has provided an opportunity for Blue Owl to do something really special. But we play a part of this broad ecosystem. So Blue Owl in total, we manage about $300 billion. And the bulk of that capital we provide as either loans or equity, but capital solutions to corporate partners. In some cases, those are companies backed by private equity firms. In some cases, are very large now public companies that are the engines behind the digital infrastructure transformation. And so when you take a look at something like what Meta is doing in Louisiana, or what Oracle is doing in Texas, and we can go through others, these are gigantic projects, even by the measure of companies of the scale of those enterprises and their peers. The kind of capital expenditures involved, $27 billion, that's just to build the infrastructure, that is, say, the buildings, the special data centers, that then the chips will go in. And the chips are a multiple of that. So when you think about one of these expenditures, like the Hyperion data center, you're talking about over a $100 billion project, which even for a huge company like Meta, requires innovation. And of course, they're an incredibly innovative company. So we partnered with them, said, look, we're in the business of owning things like big real estate projects, developing them, owning them for the long term, and we will lease them back to you to use for your very high-end application, which is data centers. So that's the role we play, which is to bring tens of billions of dollars together to be able to actually build all this infrastructure where these high-end chips will be housed and where AI will run.
And so, as I mentioned, that was the largest private credit transaction ever, the specific one with Meta. Is it only a matter of time before that's dwarfed by the next one, given the spending plans of these companies? Are you in talks for a bigger one even now as we sit here?
We have a very, very big pipeline, and I would expect that is not, the biggest that will ever happen. In fact, just looking over this last, rough justice a year, the biggest project was Abilene, Texas, sometimes called the Stargate project, but the Oracle project in Abilene, which is a project that we're developing in partnership with Crusoe, fabulous development firm. And that's a $15 billion project. That was the biggest at the time. Then about 6 weeks ago, we announced a project for $22 billion called Borderplex, which we're developing, and that's in New Mexico. And then, as you noted, last week we announced a bigger one, which is $27 billion with Meta. All three are Blue Owl financed projects. So, we're playing our part in this ecosystem. And of course, what that does create for us, and we're a public company, creates tremendous amounts of growth and a way for investors in our funds and investors in our stock to be able to participate in a really, what I'll call a very safe way in the digital transformation. Because what we're doing is providing these long-dated leases to these incredibly high-quality companies and getting paid for years and years to come.
Of course, nothing is without risk. Of course, as you know, somebody in the credit market, you know that very well. And some of the concerns that we've talked about on the public side, the public equity side of the ledger, return on equity, I think most notably the circularity of this whole ecosystem. How much do you worry about that you'll eventually get saddled with a data center that, say, has obsolete technology, or that there is no longer the demand for? How do you kind of factor that in?
Yeah, it's a great question, because there's different ways to invest in the AI revolution. Our particular way of investing is to provide large amounts of capital to the very best companies in the world under long-term agreement. So our capital, to your very good question, has been provided to Meta on a very long-dated basis, a expected greater than 20-year commitment from Meta. So actually, when you talk about risks, I would actually characterize the risk of Meta, or think about the other people we work with, the Microsofts, the Googles, the Oracles. I mean, these are, if you take a look around the world, there's 5 big hyperscalers. If you include a couple of the so-called neoclouds, maybe you have 6, 7 of these companies that we could be working with, and they're all outstanding credits, in particular those 5 hyperscalers. The idea of risk, actually the risk they won't pay their bills, I think you would call that exceptionally low. Now, are there higher octane, higher risk ways to participate in AI? Absolutely, right? The application layer, the kind of cutting edge of who will win the kind of called AI war, We don't participate in that blue owl. We like to have this predictable, steady march upward. And that's how we've been able to continue to grow our revenues and our earnings at really exceptional rates. We just turned in a quarter of 20% plus growth. And that's steady as she goes for us.
Right. As we talk about risk, we have to sort of address the elephant in the room, which is that there has been an uptick in discussion of risk recently in the private credit markets. And call it idiosyncratic, call it one-offs, whatever you want to call it. I was recently talking to a very large asset manager who said that they thought that the risks in the private credit market right now are perhaps cyclical rather than structural. That is, as perhaps economic growth slows to some extent, and as the industry just grows and grows and grows, it is perhaps inevitable that there will be more reaching for risk and maybe taking on things that are going to default. I'm curious how you think about that.
So I think it's actually really important to take a step back and kind of frame this private credit question. As you said, there's words, some more colorful than others, have been applied to private credit or a certain situation. And I think that probably doesn't do sufficient justice to the broad question that you're describing, which is, look, first of all, is the credit environment, is the credit market healthy? And the credit market today is very healthy, private credit and public credit alike. So private credit and the public markets, whether it's the banks or the private credit lenders, we're fortunate because we're sitting on portfolios that are in really strong shape. Now, very importantly, that's not flawless. We're not in a business where we expect to never have a problem. Our job is to make sure we have very few problems, and when we have a problem, we still get most of our money back. That's the thing about being a lender, right? You're the first money to get your capital back. You're the top of the capital structure, as we say it. And we don't exist in any kind of isolation. We or the banks or any other part of the capital market. So if you have concerns, if you will, about credit, by extension, you should have ever graver concerns about things like equities or any other thing that sits behind credit. There's nothing magic about private credit. When you put the word private in front of it, there's magic about the formula for how we can earn a better return through like our public BDCs for investors. There's a magic to being able to take capital and match it to people who see the value in having a capital partner. Mm-hmm. But there's nothing novel about credit. It's been done forever. We understand a lot about credit. And of course, there will always be some defaults. But the good news is with a place like Blue Owl, and the investment vehicles we operate, we've now originated over $150 billion of loans. And for 10 years now, our loss rates have been 13 basis points, so 0.1% per year. Now, they'll go up from there over time. They should. Those are wildly low numbers. But even any expansion of that still leaves lots and lots of room for attractive returns. So no one should expect there to be a flawless environment. What you should expect is for good investment managers to deliver very few flaws and then get most of the capital back.
Mark, thanks for coming in. Appreciate it.
A real pleasure.
And stay tuned for more Market Catalyst coming up. Chevron boosted its production by 21% last quarter, helped in part by its acquisition of Hess, which, after a legal fight with Exxon, gave it access to a valuable project in Guyana. Chevron's cash flow from operations beat estimates. And joining me now, the Chief Financial Officer of Chevron, Eimear Bonner. Thank you so much for being here.
Hey, thanks, Julie, for having us. Yeah, it was an absolutely great quarter. So strong across the board, beats on EPS and cash flow and record production from across the Chevron assets. So we're really happy with today's results. And that enabled us to deliver superior returns to shareholders through dividends and buybacks. And we can clearly say that the cash flow inflection that we've talked about for a while is here.
Right. I know that is something that you really have prioritized, that cash generation. How are you balancing that with investment right now?
Yeah, well, the cash generation that we're seeing today are a result of, growth projects that we've had in the portfolio for many years. You mentioned the Hess acquisition at the beginning there. That's obviously a significant contributor in the quarter since we closed in early third quarter and fully integrated by the start of this month. So that adds 500,000 barrels of oil a day. But we've also had growth from other assets in the US. Permian had their second quarter at 1 million barrels a day, which was terrific. Pacific, and we have the Gulf of America. They're ramping up their third project within a series of three, and one of the projects, Ballymore, actually hit nameplate capacity in the quarter. We're seeing growth in our international asset in Kazakhstan, so that started up and ramped up. So a lot of the growth has been laid out many years ago, and it's all coming together this year. And so the investments that we've made, we always look at the long term. We always make investments and think through the cycle, and the results are showing up this quarter, and they speak for themselves.
On the call today, I believe your CEO, Mike Wirth, said that 85% of the business is now upstream. Now, for folks who don't follow this day and night, upstream means exploration and production, getting oil and gas out of the ground. So is that does 85%, is that the right size where you guys are concerned?
Yeah, I mean, the portfolio proportions between upstream and downstream, and Mike talked about this morning, have been very intentional. And then within the upstream, we've also ensured that the portfolio, the asset classes, so think of that as the types of asset, that the asset classes were also rationalized and optimized to be high cash margin assets. And so the upstream today at 85% is very intentional, and it's after a decade of decisions, capital discipline being demonstrated, and that's why we're comfortable with where we are today. The balance of the portfolio includes refining and also chemicals, and both of those segments are very competitive. We like those in our portfolio, and we've got growth underway, in fact, in the chemical side of the business, with 2 cracker projects starting up in the next couple of years. So yeah, we're comfortable with where we are, and we think that our portfolio sets us up to have resiliency through the cycle, high cash margins, and durability well through the end of the decade.
And recognizing that it's difficult to predict where oil and gas prices are going to be, what are you planning for the next year in terms of price?
Yeah, well, we're planning for expecting more of a supply-driven pressure on price. Demand has been incredibly resilient. It is growing, and so we expect that it'll continue to grow. But supply, given that we've got some non-OPEC production that's growing, there's also some unwinds happening, and they'll continue to happen, is our prediction. So we're preparing for some softness. And again, because we make all our investments with the long term in mind, with through cycles in mind, we're prepared for any price environment should we see some pressure in the next couple of years. So we expect there may be some pressure. We've seen prices relatively flat quarter on quarter, but certainly drift into Brent into the high 50s just in the last month. And so we're prepared for that with the investments that we have. We're prepared for that with the capital that we have planned to spend. We came into the year with capital lower than the year before, both on the organic side and the affiliate side. And then we've also got a significant cost reduction program underway that's making good progress and delivering the synergies from the Hess acquisition. So all of those things, coupled with the AA balance sheet, make us feel confident that we're prepared and we can navigate it, even if we were to encounter lower prices over the next couple of years.
Eimear, speaking of sort of navigating the unpredictable, I have to ask you about a sort of developing news situation in Venezuela. Chevron has a license to drill there, of course, that was renewed earlier this year after an interruption. At the same time, we've seen U.S. tensions in Venezuela increase, airstrikes on boats in Venezuelan waters. President Trump hasn't ruled out targeting land targets as well. So are you confident you'll retain the license there? And what do the tensions there mean for your business and the employees who are based there?
Well, first of all, what I would say is we've got 100 years of history in Venezuela, and our view is our presence has been very constructive for the people of Venezuela and the U.S. We have a limited amount of oil coming from Venezuela to the US. Think of that as about 8 to 10 cargoes a month. And, the cash contribution from those cargoes is really paying debt that we're owed over time. And so that's how to think about the operations and the financials. What I'd say about what's going on in Venezuela, we are always and are compliant with US sanction policy and the laws and regulations. So everything everything that we're doing is compliant with that. And it goes without saying that the safety of our people working there is our top priority. So, we feel today that, our people are safe, and we are always focused on ensuring that's the case.
I'm curious what their priorities are around big tech, because it has been such a dominant theme in the market. There's been all this talk of a bubble. How are you guys thinking about that?
Yeah, well, I'll try not to do too many allusions to Halloween. Happy Halloween. But what we advise is the rules of the road have not changed. The rules of the road say invest according to your risk tolerance, your time horizon, and the goals that you're trying to accomplish. And so the priorities that each of the families that we serve have, they are unique to each of those families. Very broadly, their investment portfolios, we believe, should be well diversified. They should have a number of different sectors represented in those portfolios, and they should match the risk tolerance and time horizon that they have. So as it relates to tech, to the Mag 7, we would say, here it is. Don't dress up your portfolio as only a tech portfolio.
Yeah.
You're likely to get spooked when the volatility rises and falls.
You were really prepared for this,
I
Penny.
was.
I'm impressed.
So in St. Louis, where I'm from, kids have to tell a joke on the porch in order to get candy.
I love that.
And so I'm trick-or-treating tonight. I'm getting ready.
Okay.
Yeah. So what we've got to realize is that we are in the 5th strongest 6-month rally in 75 years. Now, we think there's still room to run. We think valuations are high, but they're not at all-time highs. And so we believe that the economy is strong, that AI productivity is a real thing. So we overweight equities right now, but we want people to be broadly diversified.
And because, of course, stocks have rallied so much and big tech has been such a big part of that, are you encouraging people to rebalance as a result of all of that?
Well, thank you. You know the rules of the road. That's exactly right. Use a downdraft as an opportunity to cut some gains and reallocate to less favorable sectors, because we just don't know what the winners and losers are going to be. One thing that we do know that I want to emphasize is that utilizing a financial advisor really takes a lot of the emotion out of the market. A good financial advisor works with you and your family, many times multi-generationally, to understand what's most important to you, to put into perspective what's happening in the markets, and to take that perspective and provide outlets for opportunity.
I'm curious, I heard the head of one of your competitors speaking recently. We talk here a lot about the K-shaped economy, right? And how some folks, particularly people who own stocks, by the way, are doing quite well in this economy, and people who don't are not necessarily. And this person posited that maybe we're getting to a K-shaped advising structure too, where only the wealthiest people in the country can avoid sort of Cadillac or Rolls-Royce, whatever illusion you want to use, kind of advice, and that it's hard for lower income folks who are just getting into the market to get that advice. So how do you think about that question and sort of catering to that whole watershed of folks?
Right. Well, as you said, we are one of the most ubiquitous financial planning and advice firms in the market. We have 9 million clients. We have a client in every county of the United States. Wow. Fun fact there, and all 10 provinces in Canada. So we are ubiquitous, and we really pride ourselves on meeting our clients where they are. And that's why we have a number of different ways to be served and to serve our clients. So our high net worth clients are served through Edward Jones Generations, our most bespoke, customized experience for people with very complex needs. We also have workplace services where we meet business owners and employees at their place of work, which I don't know about you, but I remember when I started as a working girl 40 years ago, the first thing that I did was sign up for my 401k. Small and mid-sized businesses employ half of the employees in this country. And so giving them access to great 401k and employer-sponsored retirement plans is a way to get started. And in in fact, most people say that getting started through their place of work is a good idea, but only about 30% of Americans have access to those plans. So that's why we're really investing there. And then investing broadly in bringing financial planning to more people across America. Because when you have a plan, you're more confident, you're more secure, you are more ready to take on the appropriate risks for your portfolio so that you can think about the optionality in your life. You can think about great possibilities, your biggest needs, wants, and wishes, and plan for those in a really thoughtful way.
Recognizing, that the individuals are different and people are different life stages, I'm curious how you all think about things like crypto and whether you are recommending that people put those kinds of assets in their portfolios.
Yeah. Here's the illusion again. Crypto looks like the princess costume some days and looks like a ghoul other days. And so if you're going to invest there, you've just got to be ready for what could be a very rocky ride. We don't advise that people think of crypto as an asset class. It's simply not. There are no fundamentals at this point that underlie it. Now, there's certainly fundamentals that underlie blockchain technologies and those kinds of things. But we don't advise people to invest directly in crypto. We also recognize that people just want to understand what this market is about, what crypto might eventually mean for them and their investments, their portfolio, and frankly, the way they save and spend. And so we are providing perspective on that. Crypto ETFs are available now. And we're seeing more interest in it than we are seeing activity in it. One more thing that I want to say about our investing lives. Research shows that when we have a really poor experience with investments and we get scared early on in our investing careers, perhaps as young people, it affects our risk tolerance for the rest of our lives. And what has happened in those moments for generations of people is that it torpedoed their confidence, and they were not willing to take on risk later in their lives that frankly they needed to have a well-balanced portfolio.
Sorry to interrupt.
No,
I'm sure that is deep research. I wonder if that's changed, though.
Do you think so?
It feels like post-pandemic, maybe, because certainly people did get burned in things like crypto, or if they were getting into meme stocks and things.
Yeah.
But then we're seeing another wave of folks, maybe some of the same folks come in. I don't know.
Yeah.